Hello and welcome to Trading Nation. I'm Bertha Coombs. Stocks coming off their lows by Thursday afternoon, but still under pressure on fears the global economic recovery from the pandemic may come in fits and starts. This as a 10-year yield touches 1.25%, its lowest level since February. We asked our next guest to cut through the noise and share the chart that explains the market dynamics in play right now. So let's bring them in. Craig Johnson of Piper Sandler and Bill Baruch of Blue Line Capital. Gentlemen, thanks so much for joining us. Bill, let's start with you. What are you looking at right now?
First and foremost, I think it's most important to highlight the Fed's balance sheet. Not the massive expansion we've seen over the last decade, but really the Fed's balance sheet over just this year. They've added nearly $1 trillion, and it underpins the Treasury complex. I mean, they're buying debt. And ultimately, what you're seeing is as underpinning the Treasury complex, you're suppressing yields. And we've seen that narrative sort of fall apart a little bit. Now, in February and March, yields ran up and pricing in inflation expectations. Now we look to the Fed's meeting in June, and they moved their inflation expectations for the year from 2.4% to 3.4%, and meaning that they're going to taper those bond purchases sooner, cut back that Fed balance sheet sooner. But the bond market, realized that the inflation is going to dissipate if they start doing that, and the bond market is calling peak inflation. So what we've seen now is yields fall sharply and the Treasury markets really melt up, saying that they're not going to be able to unwind that balance sheet at all. So you see, again, the 30-year bond is just skyrocketed. Overall, I think that the narrative we've seen here is as the 30-year bond has rallied, growth stocks have rallied with it. It's no surprise. But as we've seen these yields, the 10-year noted down to 1.25, we're reaching a point where I think it's a lot of support in the yields and a lot of resistance in the prices. And from here, I think we can see the yields tick back up again. And every sort of rotation within the stock market starts with a flush. We have a flush here today, so I'm looking for value to now lead out of this after this flush works itself through.
So you think yields are going to hold put. Craig, what's a 10-year telling you? Like, if you were, say, trying to refinance right now and hoping maybe you could get another blip lower, I'm just asking for a friend. Do you think that 10-year is going to dip a little lower and we could get an even better rate?
So, Bertha, to answer that question, I don't think you're going to get the 10-year bond yields to pull back a lot further from here. I agree with Bill. And what I'd point out on the chart that I brought in is you can see that we've pulled back to almost the rising 200-day moving average. If you were also to throw some other technical tools on top of this, you've kind of retraced back to a pretty interesting level where you would say, hey, this is a good area where we've had support. Back to the March highs, also back to those retracement levels, a 200-day moving average. And then I'd also say to your friend, Bertha, now would probably be the best time that they could go back and refinance their home because we've seen a little bit of a disconnect between mortgage rates, 10-year bond yields, and I think rates are at some of the lowest levels that we'll probably see for a very, very long time. And again, that's probably what's driving a lot of the housing move at this point in time. But Bertha, I want to add one other thing to this chart on 10-year bond yields. Put it into perspective. We've come from 50 basis points to 1.77% just a few months ago. And any technician knows you sort of back up a little bit in terms of rates, and that was pretty well accepted by the market up until the last few weeks. Then that sort of decline in yields started to accelerate. And as that started to happen, people started putting into the narrative of the market that perhaps, again, runaway inflation wasn't going to occur. That went away. And then they started saying, wow, we put all this stimulus into the economy, but yet we're not seeing any sort of inflation happening. Maybe the entire recovery narrative is fading to a degree. That's the other part that's getting baked in. Both of those, to me, are at extremes. I think what you're getting right now is just a very simple pullback.
As we close out here real quickly, if the recovery starts to falter because we're seeing this expansion of the Delta variant in certain areas, is that going to change the equation and the way you guys are looking at it? Craig?
Well, Bertha, for me, I think it would change the direction, would sort of push out the economic recovery time frame. Again, we got to be talking about the Delta variant parts of the world that haven't been vaccinated at all at this point in time, because that seems to be where the most severe responses take place. So yes, it would push out the recovery narrative to a degree.
And Bill?
I think it's a very interesting point. We saw the economy come out of the COVID pandemic. We're still in it for some purpose, but come out of the COVID pandemic and reopen this spring, and growth has picked up remarkably for that period of time. But as Craig noted, is growth going to dissipate going forward? Now, if the Delta variant expands, and I don't think it's a threat right now, but if it really starts closing down borders, starts encouraging lockdowns through, say, this winter, then we almost have another reopening. I mean, the narrative reason for growth stocks now over value, not only because of where the interest rates have been, but have also been because you only reopen the economy once. Well, now, if that were the case, we could reopen the economy twice. I mean, obviously, I think there would be some pullback and fear in the market, but I don't think anything like we saw last March, as again the Fed's already in place and underpinning the treasuries, underpinning the actual risk assets with their support right now.